Welcome to Talk Tickers. As you know, our mission is to cut through the noise, whether it's a quarter's worth of earnings calls or, like today, a massive regulatory shift that will redefine how money moves. We are diving deep into the proposed regulatory overhaul known as the Basel III Endgame, or B3E for short.
And this is such a crucial deep dive for you because, well, it sounds like this high-level abstract banking policy, the outcome is going to affect everything. I mean, the cost of your next mortgage, how easily a small business can get a loan. We're looking at arguments that these new bank capital rules proposed back in the summer of 2023 by the Fed, the FDIC, and the OCC could have some, well, profound and potentially really detrimental impacts on consumers.
Especially those who are most reliant on access to bank credit. The core tension here really feels like safety versus access. We all want a safer financial system, of course, but critics are arguing that the cure proposed here, particularly by U.S. regulators, might actually be worse than the disease when it comes to the cost of credit. Okay, so let's unpack this. We should probably start with the very definition of the term that this whole debate is built on: capital.
Absolutely. So bank capital is essentially the difference between a bank's assets, the loans and investments they hold, and its liabilities.
So that's our deposits, any debt the bank has.
Right. It's the owner's interest or the equity buffer that lets a bank absorb losses, say, from a bunch of defaulted loans without failing and, needing a taxpayer bailout. It is the critical cushion.
And figuring out how big that cushion needs to be, that's the never-ending regulatory dilemma, isn't it? What is that fundamental trade-off that regulators are always trying to strike?
Well, it's a bit of a zero-sum game. If you have too little capital, banks might be encouraged to take imprudent risks. They don't have enough of their own skin in the game. But if you demand too much capital, you significantly increase the cost of credit. Holding capital is expensive for a bank. It's money that isn't being lent out to make a profit. So the higher the capital requirement, the higher your interest rate has to be.
Right, to maintain their profitability.
Yeah, and even the Fed chair, Jerome Powell, has publicly acknowledged this. He said that raising capital requirements does increase the cost of credit and it reduces access to it.
So if we make the financial system perfectly safe by mandating tons of capital, we could basically throttle economic growth and just restrict access to essential things like homeownership or starting a business.
Precisely.
That really puts the history here into focus. Why did the U.S. even join the Basel Committee on Banking Supervision way back in the 70s?
Well, it wasn't just about domestic safety. It was really about global competition. The U.S. wanted to make sure that international banks couldn't use, lax capital rules in their own countries to offer cheaper credit and undercut American banks on the world stage.
So it was about leveling the playing field.
It was. And that original goal, that idea of competitive parity, is exactly why this current U.S. proposal, which goes so far beyond the international consensus, is causing so much alarm.
That's a perfect transition. Let's get into the specifics of the U.S. Basel III Endgame proposal, B3E. We have to look at what changed and where U.S. regulators started to, diverge so dramatically. The first huge change was just the scope of who this applies to.
Oh, the scope expansion is monumental. Before, the strictest capital framework applied mainly to the very largest banks, the ones with over $700 billion in assets.
And the B3E proposal.
It extends that much tighter regime to all banking organizations with $100 billion or more in assets.
Wow. So dropping from $700 billion to $100 billion?
Yeah.
That pulls in a whole new group of regional banks, larger community banks.
It does. It brings in about 37 new institutions, and together they hold over 3/4 of all U.S. bank assets.
And what's the consequence of making those regional lenders follow the same rules as the mega banks?
It means a pretty significant overall capital increase. Regulators were expecting common equity tier 1 capital, that's the highest quality stuff, to increase by at least 16% on average across all those banks.
16%.
Which translates to an extra $2 of capital for every $100 of risk-weighted assets. But the real story is how that number goes up. It's all in the technical changes to how risk is calculated, specifically in the denominator, risk-weighted assets or RWAs.
Let's focus on those RWAs, because this is where the U.S. basically said, we think our own domestic activities are riskier than the rest of the world does. What are some of the specific inflation numbers for, say, retail lending?
They're pretty significant, and some would argue a bit arbitrary. The proposal sets U.S. risk weights for a standard residential mortgage at 20% higher than the internationally agreed upon standard.
20%.
20%. For credit card transactor loans, it's 22% higher. And for other general retail loans, like an auto loan, it's 10% higher.
Hold on a second. If the whole point of Basel was harmonization, why are U.S. regulators suddenly deciding that a standard American mortgage is 20% riskier than one held by a bank in the EU or the U.K.? What's the justification for that?
Well, critics argue there's very little empirical data to support such a large unilateral increase. The effect, though, is crystal clear. You inflate the perceived risk, you force banks to hold more expensive capital against those loans.
And that sends a market signal.
A powerful one, it says. These loans are now less profitable. They're less desirable for us to make inside the regulated banking sector.
And what's so fascinating is that this credit risk piece isn't even the biggest single driver of the total capital increase. That honor belongs to a new component called operational risk.
That's right. Operational risk capital is meant to cover losses from things like failed internal processes, fraud, IT system failures, regulatory fines, basically the cost of running a complex business.
And the new standardized approach for calculating this accounts for the bulk of the B3E increase.
It does.
The big critique here seems to center on how they use fee income in the calculation. For our listeners who are deep in finance, how does a bank's fee income relate to its operational risk?
The regulation uses it as a proxy for complexity and conduct risk. The idea is that institutions that generate a lot of fee income, like huge credit card issuers or investment banks, are just inherently more complex.
And historically have had bigger compliance fines and so on.
Exactly. But the calculation is based on a gross measure with no cap. So critics say this just excessively penalizes businesses that generate a lot of fees but are otherwise sound, like major credit card providers.
The very companies that often provide that gateway product for consumers to start building a credit history.
The very same ones.
Okay, so we're penalizing them for operational risk that might not even be there at that scale.
Yeah.
Before we leave the technical stuff, we have to talk about the off-balance sheet item, the unused credit line penalty.
Yes, this is a really interesting detail. The proposal requires banks to apply a 10% credit conversion factor, or CCF, to the unused portions of credit lines that a bank can, unconditionally cancel.
Until now, banks didn't have to hold any capital for those.
None at all.
So if you, our listener, have a backup credit card with a $20,000 limit and you've only used $500 of it, the bank now has to hold capital against almost $2,000 of that unused limit, just in case you suddenly decide to use it.
Precisely. It turns that unused capacity into a capital drain. Now, maybe some capital is justified, but critics suggest that an empirically derived rate could be as low as 6.5%. The 10% feels, again, arbitrary and inflationary.
So the unused credit in your wallet is now a regulatory burden for the bank. Let's shift to the tangible consequences of all this, the retail and business lending squeeze. If banks have to hold so much more capital, where does that pain show up first for people trying to borrow money?
It shows up immediately in homeownership, especially for people on the margins. For mortgages with low down payments that are protected by mortgage insurance, the very product designed to help first-time and lower-income home buyers.
Yeah.
The required capital charge for those loans could increase by a stunning 80% over the current rules.
80%. That's not a nudge, that's a brick wall. It means banks will find it vastly less attractive to make loans for people who can't afford that traditional 20% down payment.
It directly undermines all the stated policy goals of encouraging home affordability. It really does.
And this squeeze isn't just for consumers, right? What about small and medium-sized enterprises, SMEs?
They face some very specific, almost punitive new constraints. There are two big penalties. First, a loan to an SME loses its favorable retail classification if the total exposure goes over $1 million. But the second one is a real cliff effect.
The single missed payment rule.
That's the one. If a small business borrower misses even one single payment over a 12-month period, the capital risk weight for that loan immediately jumps from 55% to 85%.
Wow. Just for one missed payment.
One payment. It's a huge, sudden spike in the cost of that loan just because a small business had a temporary cash flow hiccup.
Which is the definition of being a small business. They're volatile. This seems designed to push banks away from making those loans in the first place.
It certainly creates a strong disincentive. And it's not just debt financing that's targeted. The proposal assigns a punitive 400% risk weight to bank equity investments in small businesses.
Up from 100% now.
Right. So it sharply constrains a bank's ability to provide ownership financing and pushes that activity out to other, less regulated private investors.
So banks are retreating from mortgages, SME lending, and now small business equity. This regulatory pressure inevitably leads to regulatory arbitrage, which brings us to the growing concern about the shadow banking shift.
Exactly. When you make it more expensive for banks to lend, the activity doesn't just disappear. It migrates outside the regulated banking system to non-bank financial institutions, or NBFIs.
And we've seen this happening already.
Oh, yeah. Globally, NBFIs' share of financial assets grew from 42% in 2008 to 47% by 2021. The lending just moves to entities with less regulation and less capital.
And the risk isn't that they're bad actors necessarily, but that they just don't have the systemic stability of a bank's capital buffer. The risk profile just shifts.
That's the core vulnerability. We saw this play out in the UK in 2022 with that liability-driven investment, or LDI, episode. Counterparties ran on these non-bank entities, and the Bank of England had to step in aggressively to stabilize the market.
Right.
And we have similar concerns today about private credit deals funded by insurance companies owned by private equity firms. You know, it raises the possibility of policyholder runs if those credit deals go bad.
This shift has huge consequences for the most vulnerable people, which brings us to the disproportionate impact on consumers on the margins. Let's start with what you call the credit visibility gap.
This is a huge problem in the U.S. We have about 45 million Americans who are credit invisible, meaning they have no credit record at all, or they have unscored records.
And for them, getting a simple credit card from a regulated bank is the most important first step to building a financial history.
It is. It's the most frequent path. So if B3E makes those bank credit cards and retail loans way more expensive to issue, these consumers are pushed immediately into the non-bank sector.
And how big is that non-bank sector already for things like personal loans?
It's already dominant. In the fourth quarter of 2022, banks and credit unions originated only about 37.5% of unsecured personal loans. The majority is already flowing through non-bank lenders.
Okay, let's use buy now, pay later, or BNPL as a case study for the trade-offs consumers face when they're pushed out of the regulated system.
It's a perfect example. BNPL products are often deliberately structured to avoid the consumer protections in the Truth in Lending Act.
So they don't have the same rules as a bank-issued credit card.
Not at all. Bank credit cards require the lender to check your ability to repay. They have limits for consumers under 21. They mandate clear cost disclosure, dispute resolution rights. A lot of BNPL products lack all of that.
But the real long-term damage is tied to credit reporting, isn't it? It seems like it creates a system where the consumer can only lose.
That's the downside-only trajectory. Many BNPL lenders do not report your timely payments to the credit bureaus. So you can make all your payments on time for a year, and it does absolutely nothing to build your credit history.
But if you default?
If you default, that negative mark does get reported, and it tanks your score. You get all of the risk with none of the potential benefit for your financial future.
And the data confirms that this financial vulnerability is really concentrated in marginalized communities.
The disparity is staggering. 45% of consumers in low-income neighborhoods lack credit scores. Compare that to just 9% in upper-income neighborhoods.
Wow.
And if you break it down by demographics, Black and Hispanic consumers are far more likely to be credit invisible, about 27 to 28% compared to 16% for white or Asian consumers.
And they're the ones using these non-bank alternatives.
At a much higher rate, Black respondents use BNPL at twice the rate of white respondents, 21% versus 9%. So these regulatory decisions can actively compound existing financial inequality.
Let's pivot for a second and put the U.S. approach in a global context. We said the U.S. proposal diverges a lot from the international agreement. How are our peers handling this?
The U.S. approach is clearly an outlier, both delayed and diverging, which creates a competitive disadvantage. In Europe, the EU finished its legislation but chose a very long phase-in period, all the way out to 2032.
That's 4 years later than the Basel target.
4 years later. And critically, the EU included permanent deviations like supporting factors for lending to SMEs and for infrastructure projects. They essentially carved out protections for key economic areas.
So the EU is making sure its social and economic policy goals are protected, even as it implements the new framework. What about the UK?
The UK delayed implementation to 2027, and they're phasing in their capital output floor by 2030. And their justification for the delay was explicitly the uncertainty created by the US and EU going in different directions.
So they're watching to see where the dust settles.
Exactly. They're aiming for alignment, but prioritizing stability first.
And it seems like U.S. regulators are now acknowledging that maybe their initial proposal was flawed, given the huge opposition it faced.
They have. That 2023 proposal was met with just overwhelming backlash, and it forced a retreat. In September 2024, regulators announced a revised plan that would roll back many of the steepest increases.
And that wasn't just industry pressure, right?
No, it was also influenced by increasing judicial scrutiny. Recent Supreme Court rulings have been reducing agency discretion, demanding better justification for these kinds of major regulatory actions.
Okay, to wrap this all up, let's just touch on a few recent economic indicators that provide the backdrop for this debate. This is data from January 2026. What's the temperature of the economy right now?
We're seeing some conflicting signals, which suggests caution. Heavy truck sales are slumping, which is often a key leading indicator of a slowdown. Housing starts were also down just a bit, falling 0.2% in October.
And consumer sentiment is stabilizing a little. It rose 1.1 points in January, but it's still way down, about 17.7 points from a year ago. So consumers are still pretty nervous.
They are. On the employment side, we saw 50,000 jobs added in December, and the unemployment rate ticked down to 4.4%, so there's still resilience, but it's slower growth.
So bringing this whole deep dive full circle. The core takeaway is that while the intention behind Basel III Endgame is sound, we all want safer banks, the specific U.S. proposal really risked harming the very consumers it was meant to protect.
That's the critical conclusion. We need enhanced bank resilience. But the high divergent calibration of risk weights on mortgages, credit cards, SME loans, it has the undisputed effect of increasing the cost of credit. And that actively pushes vulnerable consumers out of the regulated system and into the shadow banking sector.
So you create a consumer financial health problem to solve a systemic safety problem.
You do.
Which raises the final provocative thought we want to leave you with today. Regulators say they support homeownership and don't want to diminish affordability. Yet, their proposed definition of defaulted real estate exposure actually creates a strong disincentive for banks to help struggling homeowners.
Right. If a bank gets penalized with higher capital for trying to modify a loan, it might just encourage foreclosure instead. A clean break is easier than an equitable resolution.
So it forces us to ask, when financial safety measures conflict with fundamental social policy goals, how do we make sure regulators study and address that cost up front, instead of just sweeping it under the rug as a necessary evil? That is something worth mulling over.